Hi, this is Drew Tignanelli, and we're doing update. It's November 21st, 2008. We sent you an email yesterday giving you our thoughts about the markets and where we're headed and what our investment committee is doing and why we're doing what we're doing. So here's our take on the situation. In the last 3 days, we basically sold out the majority of our equity securities. Some of our younger, more growth-oriented clients, we've kept 25% in equities, but the rest of our clients were down to 15 to 10% of equity investments. Our reason for doing this is because of the uncertainty of what continues to happen in the economic climate. We look at the Federal Reserve, who's done everything they can to try to prop this economy up, and to no avail. The things we were expecting, lower interest rates, came. The things we were expecting, the Fed to produce money and to try to prop the money supply up, it came. But yet the markets refused to stabilize. Bankruptcies appear to be mounting. Banks still seem to be in trouble, even with the equity investments that they've been given. Throughout the world, there continues to be turmoil. We are still very bullish on the concept that Asia is going to be the world economic power in the next decade or two or three. But for right now, the transition looks as if it's going to continue to be long and painful. So we made a good decision back in August to say we needed to get out a lot, and we did. We made the decision to hold on to a few of the mutual funds we own and some of the biggest blue chip companies that we own, to take advantage of any potential rebound in the markets, and thinking that these securities would be less likely to take a major downturn. None of that has proven to be true at this point in time. Many securities have been taking, even the best of the best are down 20 and 25%, and some of them easily 50, 60, 70%. Will this persist? Our thinking is that this economic downturn, and especially in the markets, is not over yet. Give you one example. In 2002, the market went down 35 to 50%, depending on what index you're looking at. In this economic scenario, we're only down 35 to 40%. And yet, when you look at the economic scenario that was present at that time compared to what's happening right now, an unwinding of credit, unprecedented unwinding of credit in the world, it doesn't give me reason to be optimistic at this point in time. The amount of pullback of the consumer in 2001 and 2002 only lasted, the fear of what happened at September 11th, only happened for about a week or two, maybe a month at the most, you could argue. But right now, the average consumer has been paralyzed and unwilling to spend money, any major expenses of money for quite a while. My indicators say that GM's auto sales could be down by as much as 60% this year. This is all good news for the Japanese automakers, but not good news for America. So again, our reason is to get out is that we just don't see any reason to be optimistic about the economic landscape in the near term, and that the stock market probably doesn't fully discount the depth of what's happening here in the United States yet, or in Europe also, to that matter. We'd rather sit on the sideline and watch at this point in time now, as opposed to continue to sit there and hope that this thing goes higher. I said in the last update that we would have a bull bounce, and I made it very clear that that bull bounce could only last a few weeks, or it could last a few months, but that would be the max that you would see. It only lasted a couple weeks, and the depth of its pullback and the speed of what came back gave us another indicator that we just can't sit here and assume that the market's going to go higher. So we're going to reposition. We're going to reposition in the safest of safe securities, because in my opinion, right now it's the preservation of our capital that's most important, so that we can buy when the opportunity becomes the most opportunistic. Risk opportunity investing basically says that risk is a determinant of the price that we pay and what do we get for the asset, for the price that we pay. And right now, the price that you're paying for the market, with the problems that are still pervasive throughout the world, and there is no leadership at this point in time to try to resolve the matter. It basically tells us that the price is still too high for the risk opportunity that's out there. And so what are we doing? We've already told you, with the assets that we manage for you, we've already made the move. We made it a few days ago when the markets were a little higher. What we're suggesting you to do is, in your 401k account, anytime you get an up move in the market, or any kind of stabilization, it looks like today could be a good day, November 21st, I would move my 401k's monies over to the most safest of safe positions that I can and sit and wait and watch. I would go anywhere from 75% in cash and bonds to 100% in cash and bonds, depending on how conservative you want to be. Because we're not going to be totally right. I absolutely assure you of that. We are not going to be 100% right as to the timing to get out and the timing to get back in. So you have to make that decision if you're willing to sit there and keep even a little 25% invested. Also, if you have any assets that are with us that you call supervised assets, means that you've either bought them or you told us that you don't want to sell them, you need to let us know if you want to make any adjustments or changes in those supervised assets. So for now, we're looking for this. I think that the dollar is the key, in my opinion. The dollar in the world markets is the key. Right now, the dollar's been strong. The U.S. Treasury bill right now, the United States Treasury bill, is yielding 0.06%. That's as close to zero as you can get. What that says is that investors are incredibly fearful right now. And as long as investors are fearful, this market isn't going anywhere. And so when the Treasury bill starts to rise again, and when the dollar starts to drop in the currency markets, that is going to be one of the indicators that we think could point the way to this. The coast is clear, time to come out of hiding, time to look for new opportunities in the equity markets. This is the greatest opportunity you will ever see as an investor if you have cash on the sidelines when this is all over. But this is not the time to get fearful and afraid of stock markets and say, I'm never going to own stocks again. That is not what this is all about. This is about being a wise investor and realizing that these times can come. And though we are down about 20% or so right now, we are going to have tremendous opportunity to make that up. And I'd rather do it from a cash position than sitting and waiting for it to recover someday, which it will. But if it's 1 year, 2 years, 3 years, I don't know. All I know is that I rethink the equity investments out when we see better what the landscape's going to look like when this thing comes, when this thing finally comes to an end. So for now, we sit, we wait. I think we're in a better position today for what we see in the future. And I'm willing to take the risk of the market going higher. If that's what it does, that's what it does. But I'm not willing to accept any more of the downside. And I think that the risk is the downside is a greater possibility right now than the upside. So with that, if you have any questions, always feel free to call. Otherwise, this is Tignanelli saying God bless.